And then, so far we've quickly grown. And I'll kind of dive in a little bit more here in a second. But so this presentation, it kind of covers the four different real estate offerings that we do up here. And it's a good comparison between our existing multifamily, our triple net leases fund, our development, and our hard money lending. And so we offer those four. So we'll go over that today. We've got some case studies at the very end as well to kind of walk you through that. And actually before that, the pros and cons of each as well to kind of compare as well as they're there. So a little bit about us. Again, starting in 2010. It was a great time to start in real estate. Before that, I was a CFO at age 28 of an oil and gas startup company for two and a half, 3 years. And then that we shut that business down as the sole client, which has a big energy, and it was time to move on. So so started CFO at a young age, but jumped right into multifamily and investing. So far over these 10 years, we've bought over $250 million in transactions, and that includes multifamily, triple net, and development projects as well. We've got 5,004 units to date in 5 different states. Right now, we're down to 4 states and about 4,000 units. We've sold some and bought some. So, but anyways, we're in Texas, Oklahoma, Louisiana, and Ohio for multifamily. Multiple markets in Texas and Ohio. There, we love both those states very much. We've got in-house management for our Texas and Oklahoma properties, and then we're about to have in-house management up in Ohio as well. So we're working on buying another property management company. To date, we've been voted in to save 3 multifamily transactions where we weren't the initial sponsor or one leading the charge. So we turned all 3 of those around in about 5 to 8 months, depending on which deal. And then 2 of them were actually being threatened to be foreclosed on. So we actually not only avoided foreclosure, but actually made money for those investors as well. So it's kind of a good foot in the hat kind of moment for the investors and for us to kind of learn from other people's mistakes. So that so far. And then on the triple net side, we've been doing that since 2017. Over $16 million in transactions, but we've got 3 more pending right now, 2 more Family Dollars and a Walgreens that are going to close. So far right now, 15 stores, 5 different states, and we expect to hit over the probably 25, 30 store mark by the end of the year as well, but we're pretty active in there. Here's a photo of one of our multifamily assets in El Paso. We're actually about to do a big cash out refi on that deal. Starting the process this month, which will be awesome. So we'll get investors back 60 to 70% of their initial investment over 2 years, and then with the refinance proceeds, and then hold it for cash flow and the tax shield as well. All right, so we picked, going into this, we started out with multifamily real estate as here in Dallas-Fort Worth, but we also wanted to be more of a well-rounded private equity real estate firm. And offering 4 different types of risk and reward ratios on these projects. They also have different tax ramifications as well. So that's something to keep in mind as well when you're trying to be efficient on the tax side. Again, we're covering multifamily, commercial retail, or triple net, as Daniel pointed out there, development, and our hard money lending offerings here too. And imagine there's a Q&A. I didn't hear Daniel, sorry. But imagine there's a Q&A at some point. So be able to field some questions.
Yeah, we'll probably, whenever you want to end your speech, we tend to have the last 20 minutes or so open for Q&A.
Okay, perfect. Okay, good. Well, save up your questions for sure.
And just to say, people can put them in the chat window. I see that some people are also putting questions for the roundtable that's coming up in there. So I'll go through all of those, and I'll read the appropriate questions for Kenny.
Okay, great. Yeah, appreciate it. So multifamily real estate, we still love it. We still are acquiring from A class to D to a D class. We're buying a D class up in Wichita Falls, Texas, buying it for $27,000 per unit. It needs about 20 grand worth of work in it, but again, taking it from a D, as in David, to a B class up there, so value add. And then we're also buying some A class, A plus stuff right now in downtown Dallas as well. So we kind of buy it all. But overall, multifamily is great. We only see the demand growing over time as folks, choose to rent over owning. With housing prices shooting up like they've done, that means more down payment, higher mortgage payments for folks, and so that's going to lead to just more demand. And we've got the same supply in B and C class. Sometimes it's declining as well. They'll knock them down, if they get too old. So kind of related to you've got more and more fish growing in a shrinking fish bowl. So that's kind of how we're looking here on the multifamily side. The loan options are amazing. It's some of the best loans you can get out there for any asset class. Non-recourse loans from Fannie, Freddie, or HUD. Amortizations ranging from 30 to 35 years on the HUD. And right now, HUD rates are below 3% still. So we're pretty excited about getting some of those, more of those HUD loans in our portfolio. And there's three ways we make money on multifamily, really on all real estate. And that's through cash flow, principal pay down, appreciation. And then there's that tax shield that we talk about there too. We call that the 4 wealth building blocks of real estate. So those 4 right there. And like I said, every real estate class has different strengths out of those 4. And that's why we're here today to talk about them. So another really cool thing about multifamily is that the valuation of these assets are net operating income driven. So, it's just very much a math equation. If you can increase revenue, make your expenses efficient, you're more in control of your NOI than say single family or even our triple net stuff. So multifamily, we're more in the driver's seat on the forced appreciation on these assets, and that's all the time what we're going for as well. All right, so pros. Again, we're in the driver's seat of appreciation. Cash flow, usually we're hitting about 8 to 10% annual cash flow on our multifamily assets. If they're big fixer-uppers, obviously there's not a lot of cash flow the first 12 to 18 months. But once we do that big cash out refi, they'll start cash flowing quarterly to investors. We got principal pay down as well. Obviously, most of the time we get 30-year AM loans. So probably another 4 to 5% a year return, just paying down the loan, assuming the value stays the same. And then we are starting to see, and we're starting to get a few HUD loans as well, where they're pushing it to 35 years, which is great for cash flow as well. And then one of the big pros for multifamily that's been around for past, I guess, maybe 4 to 5 years is the depreciation we get to take. So right now, as the tax law sits right now, what we do a cost segregation study, which we're able to speed up the depreciation on the for the investors. They get a lot of that depreciation on the first year we buy it. Typically, it's at least 50% write-off. So if you invest $100K in our multifamily offerings, then you get about 50 to sometimes 80% tax write-off in that year, depending on the asset. Obviously, let's talk about risk too. Every investment's got some risk. So risks are multifamily are very operational heavy. They're very dependent on your collections and how many toilets and light bulbs you got to fix during that month. So that's the risk part to it. And then also too, for multifamily, we have prepayment penalties, basically the vast majority of these loans as well. So that's something to think about on your timing of the exit. So if you're doing a Fannie Mae loan, which are some great rates and some great terms, then you really want to make sure you're going to hold that for probably 5 to 7 years if you're going to go that route. So just keep that in mind when you're investing. Make sure the loan and the investment time horizon that you have as a passive investor lines up with that business plan and the loan. All right, let's jump into triple net. This is the cool stuff, right? It's actually very boring. These assets, what we focus on are typically the dollar stores. So Family Dollar, Dollar Tree, Dollar General. Although now we own an Advanced Auto Parts. We've got a Walgreens coming into the next fund already. So these are all high credit, publicly traded tenants that we're going after. The publicly traded company guarantees the lease, which is amazing. So we don't have to chase rent, which is great. It's different than our multifamily stuff. And then on top of that, the triple net and double net, that's the jargon we throw around. That means that the tenant takes care of all or the majority of the day-to-day repairs on the property. Sometimes the triple net really means they pay for all the repairs, even the roof, parking lot, everything, and they reimburse for property taxes and insurance. Double net means they pay some of that. So like on our dollar stores, our Family Dollars, those are double net, meaning that the only thing that we're responsible for as the landlord is the roof, the structure, the parking lot, and sometimes the HVAC. It just depends on the lease, but that's kind of worst case. But we still get reimbursed for property taxes and insurance, which is pretty nice. So what that means is that we've got really stable revenue, and we've got really stable expenses, almost no operating expenses. And then the other expense we have is our mortgage, right? Our interest expense there for that. And that's basically fixed. So we do monthly distributions on these triple net funds that we have. We're on fund number 3 right now. We get great lending terms, not as long as amortizing as our multifamily, but still 25 years is a norm on those. And so we get probably 5 to 6% annual returns just paying down the loan. Cash on cash is right about 9% a year, but paid out monthly. And then appreciation would be on top of that. And, our first fund gained 30% appreciation over 2.5 years. And then the second fund's doing pretty well on that. But again, we're not in the driver's seat on that as much on that appreciation. So I tend not to like to talk about that as much. But that's definitely something on top of that 16% a year return through just paying down the loan.
Hey, Kenny, is this a good time to interrupt and ask a few questions?
Yeah, sure. Yeah.
All right. We've got 2 questions that are in here, and one of them is for the roundtable, or a third one that's for the roundtable, rather. But Abishaw is asking, what's your experience been with commercial real estate during the pandemic? How do you think this market will evolve in 2021 and 2022?
Very good question. So I think in 2020, what we saw were the retailers that were deemed essential and the ones that did very well. So we focused on dollar stores. So the 3 I mentioned, Dollar General, Family Dollar, Dollar Tree, they did very well. Not only did they pay us rent every month on time, but they also were hiring the whole time during COVID-19 as they couldn't keep enough toilet paper on the shelf. So not all retail is created equal. I wouldn't touch a Best Buy with a 10-foot pole. I wouldn't touch a bank branch, a Chase or a Capital One or something like that. I wouldn't buy those either. I think that's going to really change. But these dollar stores, a Walgreens, a CVS, things like that, people are going to want to still go to those just because it's just depending on what they sell. So I do think 2020 and COVID-19 is definitely weeded out some of the retailers, and also it's going to change how you order your Starbucks and all that kind of stuff too.
All right, and then our second question is from Shri. They're saying, Kenny talked about the first year there will be significant shielding, up to 50 to 80% with depreciation. How do you make use of depreciation when there's no other real estate income to offset that?
Very good question. So it can offset real estate income, but also if you have dividends, if you have capital gains from stocks or bonds or whatever, right, as well. So it's not just real estate that it can offset. It's other investment income. It cannot. I haven't found a CPA that told me it can shield W-2 income. So I don't think it can do that. But other investment income it can do.
I'd check with your CPA on that because it's obviously going to be attuned to your personal circumstances. I know that sometimes it does shield capital gains based income, but sometimes it doesn't. It depends on what your qualifications are under IRS regulations. So just to put that caveat in there.
And I've got, let me run through I just had this question 2 nights ago on a webinar I was on. So I ran through it. So, this is a real life example. So I invested $100,000 into a multifamily deal we did, and it made in 3 years, 84%. So, when it sold, I got my $100,000 back plus my $84,000 in profit. That $84,000 obviously, would be hit by capital gains tax. But in that same year, what we did is we bought another asset and I put all that 184,000 into that new asset, I was able to write off $90,000 on that same year's taxes, and so I didn't pay capital gains tax on that $84,000 profit from that sale. It's just pretty cool. So if you do that, it's very cool. It really enables you to snowball your holdings and really grow your passive income streams. But you're on a treadmill to keep buying real estate the rest of your life, because once you sell it and don't buy something that covers that capital gains, obviously you're going to have to pay Uncle Sam at some point. So anyways, just keep that in mind. But it is a very useful tool to be able to use that depreciation. And yes, check with your CPA and make sure they walk you all through that for your personal circumstances. That's the asterisk I got to add on there. So, yeah. So, anyways, all
right.
So on back to the triple.
And Kenny, one more question. I wasn't 100% clear of your definition of a triple net lease. Can you explain that a little more clearly?
Yeah,
and maybe other people were, but yeah. Go ahead.
No, it's okay. Yeah. So a good example is this. So we're buying a Walgreens in Franklin, Kentucky, town of about 9,200 people. But anyway, so it's a true triple net lease. So when we did our due diligence, we saw maybe 2 or 3 kind of watermarks on the ceilings, on the ceiling tiles. But it's a true triple net lease. So Walgreens is going to replace that roof at some point whenever they feel like it's the right time. To protect their, all the stuff on their floor. So, but a triple net lease means that they're going to do the full upkeep of the property, and they also reimburse you for property taxes and insurance as well.
Okay. We don't have any other questions at this point.
All right. Well, good. We'll keep rolling, and guys, keep them coming on the questions. So our triple net funds, again, this is our 3rd one. But yeah, these are really for folks that really want to grow, have that boring, steady, stable monthly income, and have it rolling in. There'll be some appreciation, but again, the real reason why a lot of folks invest in these with us is for that monthly ACH they get to their bank account. So pros and cons. Here you go. So pros, we're not buying. We're not buying any strip malls with kind of mom and pop owners. We're focused on our tenants are publicly traded, and the reason why we do that, why we focus on that, is because their financials are public information, and so we can dig in, make sure that they can pay us rent. Whereas a mom and pop owner, you're looking at IRS or tax returns, so that may or may not be accurate. But anyways. So that's kind of why we focus on that. We get long-term leases. Usually they're between 5 and 7 years left on that lease. We've got very low operational risk. We get some depreciation, but it's smaller than multifamily. So a lot of our investors actually mix the two. They'll invest in a multifamily asset to get the benefits there, the cash flow and appreciation. And then they'll invest in one of our commercial funds, where they don't get as much depreciation, but the depreciation from the multifamily can offset the income that they get from the commercial fund. So anyways, it's a good they pair well together. We get 25-year AM loans, so equity is a little bit faster than the multifamily. And then the risk of those is, again, was your property essential in COVID-19? I think that really pointed out what retail is going to be here for the long haul. And then really, the value of your property is based off how much term you have left on that lease and who's guaranteeing it. So obviously, Starbucks or Dollar General guaranteeing the lease means a lot more than just a mom and pop store as well. All right. So for the real estate development arm, what we did is, this is for investors that really want that high appreciation and eventual cash flow. But really what they're looking for is to double their money in the first, 2 to 3 years. So that's what our real estate and development projects target. We do both ground up. Right now we're building 88 multifamily units from ground up. We're shovel ready, about to start moving some dirt. And then we also do redevelopment. We think this is going to be actually a really big a growth spot for us. We bought the Rockefeller building in downtown Cleveland. It's an old historic office building, still office today, but we're going to convert that to high-end multifamily units. So we've got 3 more office repurposing projects under contract or about to go to contract in downtown settings. One's in Cincinnati and one's in Fort Worth, and we're looking at a few others. So anyways, we're looking at that. Again, this is a high appreciation model. So, we're looking to double investors' money in 2 to 3 years, refinance, and then cash flow after that. On the refinance, hopefully to get them that 50 to 70% of their initial equity back to them, which is obviously a tax-free event because it's a refinance. They can reinvest that however they want, go buy a Tesla, whatever you're into. And then we still own the asset, the cash flows, we got that tax shield until we sell the asset. And this is more of the kind of fun, creative HGTV moment kind of investment if you're looking for that. So again, the pros are this is folks looking for kind of a high appreciation, looking to double your money quickly, refinance in 2 to 3 years for a cash out. That's always the goal from actually our multifamily and our development assets. This is more of the creative investment. We enjoy it. We got to work with architects and all that kind of fun stuff, and then have a printed. You've got a. What's also nice is that you have you got a finished product that has brand new ACs. You've got brand new elevators. Whatever your systems are, they're brand new on there. So. And then the risks, this is probably of the 4 that we do, this is the highest risk, but it's the highest reward as well. So, development times, you got to make sure you build it correctly and fast, under budget. And then today, we look at, we base our projections off what rents are and demand are today. And then the project's probably done in about 2 years. So, has that changed? There's a little bit of risk there. And then also labor materials. We saw that kind of fluctuate. Lumber is the last kind of material to come down. So we're waiting on that, see if that comes back down to reality a little bit. And then also timing of a refinance and loan terms at that time. But anyways, those are the risks to development. All right, our 4th and final one, and then we're going to do some case studies, and then we'll just keep the guys keep building up those questions for me. But so hard money lending, this is the risky that we do. So we guarantee investors an 8% annual return quarterly. We're in the first lien position on these assets. We only go up to 70% loan to value max on the life of the project. Typically, they're 12 to 18 months. We're actually getting paid off today on one of our hard money loans. Actually, the one in the case study, we're getting that paid off today. And then this is a stable, steady income deal as well. And again, this is the lowest risk of the offerings that we do up here at Wolfe Investments. So kind of cover those pros real quick. So guaranteed 8% annual return. We can't guarantee the other returns because those are not loans. This is a loan. So that way we can. And so what happens is we've only had to foreclose once. If we do foreclose, the investors in the hard money lending side on our side get that 8% annual return. And then once we sell that or develop it, whatever we do, we get, after 8% annual return, they get 50% of the profits. And then obviously Wolfe Investments gets the other half. So it's a loan backed up by real estate, typically a 6 to 18 month investment horizon. And then we're only lending business to business loans. So we don't do homesteads and all that jazz. It can take longer to, if we have to foreclose, then it can take longer if you do homesteads. Risks. There's really not a lot because we're the first lien position. So, and we're pretty low leveraged for a loan. So it's really kind of down to, will they hit their business plan, their timeline? Will the finished product be well done and demand to the public? And then, the question we ask pretty quickly upon someone applying is, how can they pay us off, and what's the timeline for that? So on those.
All right, we have had a couple of questions come in. Um,
Sure.
and thank you for going over those three areas. So, multifamily investment, triple net leasing, and then hard money lending. Um, did I summarize those three correctly?
And then development.
And
One more.
development and
Yeah.
development. Okay.
Yeah.
All right. So we've got a couple of questions here. First one is by Siva, who is asking that do you are can you invest in these types of deals through an IRA?
Yeah. So we have IRA investors invest with us all the time. Solo 401k as well. Um, if you're going to invest through an IRA, I kind of lead folks to invest in either our hard money side or the triple net. Because if you've invested your IRA on these on multifamily or our development, we use leverage as part of that investment, and the IRS actually has a tax. It's called the UBIT. So check that out before you use your IRA to invest. But obviously, our hard money lending, you would be part of the lend on the loan side, so there's no UBIT. And then the IRA, the why I suggest the triple net is because we don't get as much depreciation. So if you want to be really tax efficient, you would use your invest in with cash in our multifamily or our development deals, and then if you want to, I'd say the IRA and the hard money lending and or the triple net would be the best way to do that.
All right. So Vasu, yes, this video is being recorded, and we will share it up at the videoportal.intel.com on the Real Estate Investment Club channel. Abner is asking, you talked about the expansion of West Texas market. And more specifically in El Paso, what is the future projection for those areas?
So we love West Texas, where we've got about almost 500 units there in El Paso. I'm actually going out there for the day and on Tuesday. We like it out there. It's very diverse. When we're looking at a multifamily market, what we look for is it landlord friendly? Is it a diverse economy? So not just one economic driver in the town. Does it have historic population growth, low unemployment? Those kind of boxes to check. And El Paso definitely does that. So it's a really cool city, actually. It's 1 million people on the U.S. side and about 2.3 million on the Mexico side. So anyways, it's a really cool city. For the median income is pretty high as well. So we see rent growth and demand just being continued to grow there in El Paso.
All right. And then Joseph made a comment. If you claim real estate professional status, you may be able to use your real estate losses to offset your W-2 income. And that is definitely true, Joseph. It's actually kind of an advanced tax strategy technique. One of the ways that people also take advantage of that is that if you work a full-time job, your spouse can also qualify as a real estate professional. And then you can offset your earned income, your W-2 wages, with your passive real estate depreciation. But you have to qualify as a real estate professional under the IRS laws, which means you have to, have done at least 1,000, I believe it's 1,000 hours that you have to log on the job. And it has to be the job that you spend the most amount of your time at. So if you've got multiple jobs, it has to be the one where you spend the most time at that particular job. So look into real estate professional status if you want to learn more about that. But that is a way of making your different income categories cross over.
Right.
All right. Glenn says, when you're structuring your funding for triple nets, is this transaction oriented, or are you doing this through a fund which could contain a portfolio of triple nets?
Yeah, it's a very good question. So we do a fund. So we're in our third fund now. We raise money for 12 months. Kind of a rolling fund, and then we shut it off to new equity. But during that 12 months, as we're raising equity, we're adding stores. We're buying stores with that equity that comes in. So on this third fund right now, like I said, it's open for investment. But we've got a Family Dollar closing next week, another one the first week of February, and then that Walgreens should probably close late February as well. So we've already got properties going into that fund. Ownership will fluctuate. Obviously, as more folks come in, ownership goes down, but it allows us to buy more assets underneath that one fund. So folks are spread over multiple stores in that same fund.
All right. And then I think you may have just answered Mohammed's question here, who is asking what type of private equity fund is it? So if you don't feel you've answered that, go ahead and comment.
No, yeah, sure. So of all the 4 offerings that we do, the only one we put structure as a fund are the triple net. And that's really to de-risk it somewhat because these are a lot of them are single store or single tenant buildings. So it's kind of like, when you're going into single family, your most dangerous time in single family was when you only own one house. You really need to own 3 or 4, so that way if one goes vacant, you can cover the mortgage with the other 3. So that's why we decided to do it underneath the fund, kind of de-risk it. We don't think these stores are going to close, but we got to look at the downside as well. The first fund, I think we put 7 in there, and the second fund we did 8 stores. So we've got 8 stores in the second fund right now.
All right, and then Abishaw is asking, how long do you typically own your real estate assets? I'd like to get a sense of the duration of cash flow after the refi.
Yeah, sure. So, we always coach folks on our multifamily assets. Usually it's a 5 to 7 year hold. We try to do a capital event in the first 2 years. That way investors get, 50 to 60, 70% of their initial equity back, and then we hold it for the remaining 5 years or so. And that way we can burn off the prepayment penalty and then also enjoy the tax shield and the cash flow. So typically about a 5 to 7 year hold. We're not a fix and flip company. If someone made us a stupid offer, there's always a price, right? But we prefer the longer term hold and enjoy the cash flow.
Okay, so we don't have any other questions at this point. If anybody else has questions about either returns or times or capital for any of these 4 investment strategies that he mentioned, and if you have any other educational content that you'd like to present on these strategies,
sure,
I'll let you talk.
Studies. That way y'all can see the actual things that we own, right? That's always exciting. This is one of our multifamily assets that we bought in 2015 in Columbus, Ohio. It's 216 units. You can see we really grew that NOI from $1,025,000 to almost $1.3 million. So it's done very well for us. Initial equity investment is $3.7 million. And actually that gain's a little bit low. We just had some brokers value it for us, but so we paid $13.75 million for it, and it's worth about $24 million today. So it's over a little over a 2x, 200% return. So or a 3x deal. So if you put in 100,000, it's worth about 300,000 today. It's a beautiful asset built in 2000. We really drove the value because the interiors had not been upgraded since 2000. So we did faux wood, black backsplash in the kitchen, stainless steel appliances, really kind of dressed up the interior. And that's where you make your money on these kind of assets for a multifamily side. This is an example. We bought a Family Dollar in Fort Smith, Arkansas, at an 8% cap. Interest rate, I think, was right around 4% on this one. So we've got a pretty high cap rate to interest rate spread. Cash flow on this one, and again, this is in one of our funds, our second fund. It's to investors, it's about at 10.6%, and the calculated principal pay down, assuming no appreciation on the deal, which we think there will be some, but assume there's none for this for that return, almost 8%. So this one is a heck of a deal. We like it. It's on a busy road and close to a church and a couple schools, so which keeps it pretty busy. Development. This is the first development deal we did. I had never done development before, so I bought these myself. Townhome lots built on ground up, and they're doing really well. We've already doubled the money in the 20 months it took us to construct these. So it's been a good little investment, and it was a way for us to really kind of build the team. So again, now we're working on the 88 unit multifamily deal ground up here in Dallas, Fort Worth. we have all the team, and everybody kind of worked out through my guinea pig project that I did. And then the last one is actually this property is supposed to be paid off today. I got to check the bank account here in about an hour, but but we lent $1.6 million. We closed it about a year ago, so this is before COVID, but it's a venue / hotel space, and they actually worked through COVID and did okay. They never missed their mortgage payment, so and they did well enough that they're about to get refinance us out of the deal. So we've owned it. We were in a lender for about 12 months on the asset, and then returning about a 8% return to investors quarterly on this one. And there you go. That's those are the case studies. I went fast, guys, because I think the Q&A is almost just as valuable as me going over all that stuff. But anyways, this is a way to contact us. There are probably the best way is through our website, wolfe-investments.com. We also in March started a YouTube channel. It's all educational content, so definitely check that out. We cover everything from all different 4 asset classes to the 4 wealth building blocks and all that. You can find me on LinkedIn, Facebook as well. We're pretty active on social media. And if you have any questions or anything, that email right there is the best way to get a hold of us.
All right, there is one question from Mohammed. He says, "How do you give the equity back to investors after you sell your multifamily?"
So on a sale, yeah. So I'm going to read this. I think the question was about our deal structure. I'm guessing. If it's not, correct me. But so what we do is we don't do any upfront acquisition fees. It kind of sets us apart, and we don't do a pref. So what we do is just a straight 80-20 split of the cash flow, 80% going to investors. On a refinance, it's an 80-20 split too. On the proceeds, 80% going to investors. And then on a sale, investors have to get 100% of their initial equity back through the refinance and or the sale before the 80-20 split kicks in. So it's all very straightforward. There's no, you don't have to pull out a science calculator to figure out the returns to everybody. Pretty straightforward. And the reason why we like to set it up that way is because we're always aligned with our investors. If you do it the other way, there's some upfront fees. The syndicator doesn't make a lot of money during the hold period, and then at the end is when they make a lot of money as well. So anyways, we set it up that way. That way we make money when the property makes money, and that always aligns us with the investors. And on top of that, we invest in every single deal as well.
All right, we don't have any other questions at this point. Alexander has an interesting question, but I think it's something that I should find another speaker for. And his question was on timeshares, which we've never talked about in this group. So I'll see if I can find someone to do that.
Okay. I always hear commercials of people, trying to sell their timeshare. So
yeah,
keep that in mind. Well, good, guys. Yeah, definitely check us out. If you want to get on our, check out and follow us too through email. There's a big red subscribe button on that website. Click that, and then also it'll prompt you. You can opt in if you want to set up a call and or meeting here in our Plano office. And once we have that, and you still want to be an investor with us, then we can put you on to our investor portal.
All right. And one quick club announcement before people go. We've had a request to bring back the lunchtime discussion groups. And so I'm going to send out a discussion group for next Thursday for people that do single family rentals. And if you want to, come and chat, and there's no set agenda, next Thursday, single family rentals. All right, Kenny, thank you very much for coming on.
All right. Thank you, Daniel. Thanks, guys.